Hello, welcome to our Collateral Plus podcast series. I'm Michael Morley of State Street Global Marketing. I'm joined by Ingvar, Sigurjonsson, and Travis Keltner, both managing directors in our Financing Solutions and Collateral Optimization group. We're here today to provide some insight on how the calculus for certain financing transactions and collateral management, and with respect to clearing in particular, has changed in recent years. Travis, can you give a bit of background on clearing generally and offer some examples of how it works?
First off, Michael, thanks for having us today. It's great to be here. I think clearing in itself has really gained a lot of traction on the buy side over the recent years, really as an evolutionary settlement and risk kind of mitigating mechanism that's really coming front and center across a number of products. And really at its core, clearing offers a way for kind of counterparties to generate liquidity across a variety of products, derivatives, financing, and a more diversified risk construct. And what I mean by that is ultimately counterparties may share or mutualize the risk via the central clear in whatever product kind of domicile they trade in. And in effect, it redistributes risk in a traditional versus like a traditional bilateral relationship, really to a pooled set of risks that are appropriately managed through additional requirements such as clearing funds, bar-based calculations, and that may also drive additional margin needs. And I think it's important to note that traditionally clearing is common in the derivative world, and it's talked a lot about, and there's a lot of focus, but it's really important to note that in our securities financing repo world, these structures exist, particularly in repo and securities lending. And really just to highlight a couple of those examples, I think it's, folks that may have heard a lot about the FICC, which is under DTCC, kind of the sponsored repo clearing service, which is bringing the buy side into the kind of dealer-to-dealer markets. NSCC under, again, DTCC, which clears equities, is exploring ways to clear equities through a lending construct. Internationally, we have LCH and Eurex peppered in with themes of clearing and exploring sponsoring. And then, not necessarily clearing, but clearing, some of the benefits of clearing can also be translated over to peer-to-peer products where firms are looking to indemnify transactions and step out of them. So there's that, and then the broad range of jurisdictions beyond what I've highlighted that really showing interest in clearing as this continues to gain steam, not only in the derivatives but in the financing markets.
Great, thanks, Travis. Ingvar, clearing has long been utilized by the sell side, but more recently, buy-side institutions have increasingly entered the space, either through sponsorship or even direct membership of clearinghouses. What are some of the driving factors in that migration?
A lot of it's regulatory driven. CCPs, as Travis mentioned, they're designed to really reduce and manage counterparty risk and settlement risk. And because they're generally perceived as systemically important, they're subject to strict supervision. So that enhanced transparency and risk mitigation is viewed favorably by regulators. And they've been kind of pushing the market in that direction. In the derivative space, some instruments have been made actually mandatory, but trading derivatives bilaterally also been made more expensive through higher capital and collateral costs. But for market participants, in addition to the risk management costs and liquidity are really key factors. The buy side's increasingly looking towards voluntary clearing because that's really often where the liquidity is. And with UMR, with the uncleared margin rules coming into play, that's in some cases going to incentivize clearing even further by increasing collateral requirements and costs of bilateral trading.
Absolutely. The findings of our recent UMR survey demonstrate that this incentivization is working. 56% of institutions reported that they're considering reducing the volume of OTC contracts to lessen the impact of UMR. Around 2/3 of those firms said they will trade only cleared products, while the other third will leverage a what-if process to trade offsetting and netted contracts to a select number of OTC brokers. The survey also found that 64% of firms prefer settling pledged collateral via third-party custody with account control agreements, while 37% prefer full services through a tri-party agent. Travis, can you speak to the benefits of these different models?
Yeah, no, I remember kind of reading those results, and I found those statistics pretty interesting, but also reinforcing a particular message that, to what Ingvar was saying around incentives, what you're highlighting, and really whether it be operational, regulatory, or someone call it alpha intrusive. There are incentives, but also herd mentalities that drive people into a clearing or certain, collateral pledge model. You think about tri-party versus third party. Tri-party is typically more expensive than a third-party model, but may be required given the benefits of collateral management to your latter point. And the buy side may have fewer needs. But I think it's really important to understand that kind of reducing your internal costs as well as dependencies on the sell side is also, to Ingvar's point, he alluded to, it's really leading a new paradigm of buy side empowerment, which is what this is telling me, kind of somewhat directly and indirectly in these survey results. And clearing is really one option that can act as a partial bridge to this, and particularly a program that uses the clearing mechanism where buy-side firms may enter a highly liquid market directly or via a sponsored model. And then I think it's, to delve in a little bit more on the sell side, specifically, it's really important to say, and I like to use an analogy, but the sell side is constantly looking at their own regulatory and shareholder costs. And at the end of the day, they only have so much of this kind of tasty pie to divvy out. Each firm's unique balance sheet constraints sizes that pie. And, we've heard items like balance sheet leverage, liquidity, capital management are kind of some of the examples of core inputs to that. And the more products, such as clearing, that can reduce the spread and spread the, essentially neutralize or spread the risk or add efficiencies to a sell side's capital base, the larger the pie they can break out. And of course, the pie has to taste good too. So pricing, returns, service quality, and the relationships help drive that as well. So perhaps that's kind of why you see a service premium on cleared transactions in the financing market. The more competitors in the free market, the more a market paradigm shifts to service and empower the buy side in that sense by creating that larger pie. And these incentives to clearing that we highlighted in that survey are one way that we can see that.
That's really helpful context. Thank you, Travis. Ingvar, you recently wrote a paper that covers key considerations for buy-side firms navigating the derivative space and how it can be a complex decision-making process to optimize their collateral program. Can you give an overview of the driving factors in that evaluation process as it relates to cleared and uncleared products and the advantages and disadvantages of clearing a transaction?
Sure. We've noted some of the advantages already of clearing, including enhanced risk management, access to liquidity. But there's disadvantages as well that kind of complicate the decision of whether to clear or not. Clearing tends to be more fee intensive for one than bilateral execution, and eligible collateral set tends to be narrower. And that can be a problem for some. We know, for example, that some pension funds have had challenges with CCP's requirements to post variation margin in cash. They're used to being able to meet all their collateral requirements through their pretty expansive bond holdings, but now they need to settle same-day cash margin calls. And that means they need to have the right amount of cash on hand in the right place and in the right currency. They don't want to have too much because that creates a drag on performance, but they don't want to fall short either. So this has put additional pressure on their treasury function and has really forced some of them to re-examine their structure and their operating model. When you get into collateral costs, that can get even more complex. All else equal, cleared IM should be lower than bilateral IM, whether you calculate it using SIM or grid. But UMR does introduce a threshold, which is about $50 million in the US, so that if the initial margin calculated is below that threshold, no initial margin needs to be exchanged. So that essentially lets funds with appropriately sized portfolios of in-scope derivatives, they can, in a smart way, spread their trades across counterparties, end up pledging very little or even no initial margin at all. But once you cross that threshold, then clearly clearing is quickly going to become more attractive to some. So it's not an easy decision that funds are faced with.
Okay, so Ingvar, Travis, given the complexities of these decisions within the context of a collateral management program, how can firms determine whether clearing certain products is optimal?
We believe analytics and trading tools to guide decision-making can really aid our clients. Being able to run what-if type analysis and link together margin and collateral costs with fees and other trading costs, that can really help managers make informed decisions on whether to make the investments in clearing infrastructure or not.
Yeah, and I would say, so I think it's also important that, at a high level, each firm needs to really kind of assess their own unique needs. Do we need this for market liquidity? Is this for improved pricing? Are we lowering the drag of anticipated costs around cash and collateral management? What are our weak points? Are they operational? Are they trading expertise in the front office? Those are the types of things we need to, how do we want to use this product? And And really, Ingvar highlights with the analytics, whether it be in financing or derivatives transactions, the total cost of the trade really needs to be considered. So if there's a heavy operational burden, or whether your tri-party costs or your bilateral versus cleared costs from either under and over certain thresholds, those all need to be considered in your analysis and scenarios to really find the right mix. Things like margin fees, other spreads kind of consumed, those all should be baked into the overall decision-making process to say, well, what's the best way? Do we go bilateral? Do we go cleared? Do we use tri-party? Do we use third-party? Or do we go DVP? All those types of mechanisms should be broken down to each firm's unique structure. And at the end of the day, right, it's, how would you create that nice mix between, call it cleared or bilateral? And in repo, right, I think we see that happen in the market broadly. There may be balance sheet accommodation where it may be okay for a firm just with no margin, no additional costs to go use the balance sheet of the firm. But then beyond that, or maybe there's other reasons that they want a mix of cleared repo. And I'm focusing on repo here, but this applies broadly. We see, periods around quarter ends where there's a lot of scalability in cleared, but less access in the bilateral space. So you'd want that mix. If you're someone who gets pushed off someone's sheet at quarter end, you might want to have cleared solution ready to go so you can meet your own investment needs as a buy side firm. Maybe it's a money fund, maybe it's an insurer, maybe it's a pension or some other client or counterparty that needs access here. So the last point I'll make is that less operationally burdensome really help empower the buy side. So clients offered by custodians where everything can be kept in house, where there's a central pool of liquidity and custody positions, can really allow you to use different products together and sometimes create transformation trades. You think about a repo used to meet a UMR margin demand. Those are examples that we should think about all happening in the custody network.
Okay, so given all of that, how should institutions think about clearing fitting into the toolkit of solutions in the derivatives and financing space?
I'd emphasize that it's not a one-size-fits-all solution, but rather it should be a balance of products at the buy-side firm's disposal. And that should all be supported by actionable analytics that allow you to best manage your costs and really put your assets to work for you. But for an increasing number of buy-side participants, because of all the things that we've mentioned, clearing may feature prominently in that toolkit going forward.
Yeah, I'll throw it with a different spin. I think it's really about being prepared to be ready for and address essentially a dynamic or shift in multiple types of markets and regulatory scenarios. In theory, the more tools you have available at your disposal, the more you'll be able to accommodate flows of kind of market shifts where we see more regulation, which may shrink the sell side provision of services and increase the need for things like clearing, or what we're looking at more closely, peer-to-peer models, which essentially take the sell side out for the most part, as well as clearing trades. And the sell side does this for themselves, but we need to get the buy side empowered so that they can handle those evolving constraints and avoid and mitigate those with their own tools.
Absolutely. So what is State Street doing to broaden the toolkit for the buy side?
Well, as part of our end-to-end Collateral Plus offering, we do offer analytics and tools and capabilities to clients to run what-if scenarios that'll really help them assess what model is right for them, but also pre- and post-trade analytics that allow them to achieve and maintain optimal positioning to minimize their collateral costs. We very much see that collateral management is moving into the front office, and we think that optimizing your collateral cost from the point of trade can be a competitive advantage for our clients.
Yeah, I'll say with the financing lens, we're really trying to stay, we were one of the first clearers in the sponsored space since 2005. And we have a vision to invest heavily in these types of solutions, which allow firms like ourselves punch above our weight. Investing in new jurisdictions, investing in enhancements to the sponsored products, whether it be in collateral classes or tenors, or going beyond the clear space in kind of peer-to-peer constructs. It really boils down to that theme of empowering our custody clients and our core base, because that's what we want to do. We want to put that at their disposal. And so hence, clearing in the financing space is somewhere we really want to drive in our growth strategy. And I would just kind of close up this question here by saying it's not derivatives or financing. It's not, settlement structures or cleared versus bilateral. It all comes together. And that's one thing I think Ingvar and I would like to push is really the overlap between financing and collateral management, because at the end of the day, it's all the same resources. It's one optimization that really will help a trading desk and an operations group kind of boil down an ultimate cost saving or alpha generating initiative for a firm. And these tools essentially will allow them to manage these in a much more efficient manner.
That's a great way to wrap it up. Thank you for your perspectives, gentlemen, and thank you for taking the time to listen. To get more thought leadership and learn more about our solutions, visit the Collateral Plus webpage on statestreet.com, and do get in touch if you have any questions. Thank you.